cover our yen pairs again, like I did yesterday, just to give you a bit of an update on where I'm at. Now, you'll notice if you go on my profile and you watch my stream, and I posted it on the euro yen, I said about taking it long on the fall. Okay, you've had a bounce and you're up. I also said about taking it long here. Now, this is the reason exactly why I DCA, especially when you've got harsh running markets. So when your market sentiment suddenly changes, like it did for the Bank of Japan, it was negative policy change or potential changes, and that's what set things off. Okay, people now, if they know that the Bank of Japan or it may be likely to put their rates up, they probably prefer to save their money in Japan, and you get this big drop on the US dollar and an increase in the value of the Japanese yen. Okay, because people want to save their money. Now, that kind of sentiment suddenly and rapidly, is pushed back away with what you can see here. This is very harsh rejection. And as I always say, it's no coincidence. You always get rejection at an area of price action you've seen previously. That is what caused this spike up. Now, like I said, I like to DCA because when the market is falling harshly as it was, okay, we all know yesterday it was because it went down and down and down and down and down really quickly. Okay, and what I'm referring to precisely is the point here where you've got hardly any movement to this. Now, that was everything in between, all those candles was really harsh. So it's much harder to pick the exact point where you're going to rebound. But if you drop your size and you DCA, you don't really need to worry about that too much because ultimately, once it does bounce, there's a good chance it will come back to where you were. And if it doesn't, you can still DCA further and hedge further in line with my rules particularly. I mean, it might differ for you. But the point I'm trying to make is that instead of having one big size and taking one big position, you can drop your size and spread it out. You're basically casting the net wider to catch more fish, if you like. It's just a little bit more risk averse, but I did call it long here. You had enormous rejection. So when you see a candle like this, it's telling you, much like I said for gold and assets like that, that the market is saying, you know what, we want our short profits. And when people, or investors particularly, with lots of money and lots of capital, take their short profits at the same time, you get this rippling up effect. And the common newbie mistake is experienced all day, every day. Okay? And that is short lows. Now, people do this all the time, and they send me messages all the time about selling lows and buying highs. And the problem with selling lows and buying highs is you're naturally defeating the laws of the market. You're pushing away the facts of how markets work in any sense, and you're going off something completely wrong. Now, if you don't believe me, this is the key point. If you don't believe me on that, just look back. Okay, you can see it over and over again. If you sold the lows there, you lost money. If you sold the lows, you lost money. There are occasions where if you sold the lows, you would have made money. That is absolutely right. But overall, if you zoom way, way out over the very long term, you will not make money selling lows and you will not make money buying highs. Okay, I previously called it short there. There's an editor's pick of that. And I previously called it short there. I did a video of that in November. I said, you've come back up here to this key level. You saw it get absolutely smashed last time. What do you expect this time? Do you think it's going to be the same? Do you think perhaps people are going to short? And it's no different here. You had long-term investors, you can see, who've just pushed down to that 40 MA, your key 40 MA, who've then decided to scale back in long. And that went off the back of previous price rejection. So it's not a random surprise, is it? It just turns out that if you liquidate your shorts at lows, you'll make more money. And if you buy at lows instead, you'll make more money too. Okay? If you're exiting a short trade for profit, you are long. effectively you're buying. A lot of people don't understand that. Okay, so on the other hand, if you don't exit your shorts, and this is where FOMO comes in for a lot of people, if you don't exit your shorts, you're a seller, and therefore you're selling into lows. And the longer you hold those shorts in profit, the more likely it is that this is going to happen. This big rejection is going to occur. Okay, that gets more and more and more likely as you come down from the highs, okay, all the way to the low, which you can see is a stretch from 141 to 151. It's quite a long way. So the other option really is to short every pullback, which is absolutely fine. And in many ways, you'll probably make more money. But whether you held it or not, you should be liquidating when you've got value. Okay? Or you should at least lock in profits. Now, if you're someone who panics and says, I don't know when to exit, just bear those rules in mind. If you're not exiting a short at a low, you are selling. You are still selling. And because you're selling into the lows, you're going to find it hard naturally to make money doing that. Now, it is the same, more or less, that if you look at your Swiss yen, okay, you had major rejection. I also called this long. Hopefully you took it. I did it on my post. I called all of them long on the fall, and they're all well up. Okay. So you should be out on your Swiss franc yen as well. I think there's a chance that you may get a slight jitter where you are, but a further retracement higher wouldn't surprise me. And if you do get it, I'd say near a 166 is ideal for rescaling shorts. And potentially, if the market sentiment continues on the basis that they're going to end their policy rates, okay, or their approach is going to change, you may find a continuation that lasts like this. Okay, so you would then be selling your negative sentiment for the Swiss yen, which is what you've got, because if people are investing their money in the yen, that is negative for its counterparty, in this case the Swiss franc and everything else. Okay, your CAD, your AUD, all of it. So the key thing is here, again, just like if you didn't exit your shorts, you were a seller at lows. If you don't exit longs, you are a buyer at highs. Now, I know you're not at a high yet, but you've got to understand that every move you see in the financial markets is relevant to time frames. Okay? Everything. And your trading style is relevant as well. If you're a swing trader, you would hold for longer gains. Okay? But you've got to understand that move up on a 1 hour or 4 hour is quite a long way. It's not on a daily, or it's not on a weekly. Okay, so you've got to decide what way you're trading, because the style of trading is going to directly correlate to the length of your exits and entries, and also the size of them. All right, so that's really key to remember as a point. CAD yen is the same, AUD yen, all yens for me. I think you may run slightly higher, and I would really say up here is going to be very ideal at the next level of key resistance to continue your short bias. Really, you need a pullback to do that. Don't rush in and short immediately. You don't need to. Okay. That again would be an example of FOMO. You would be jumping the gun immediately. So that is the yen pairs. Don't forget to get my free training underneath. If you are just coming in this stream as well,